Hello, my name is Thomas Kwa, and welcome to this session, Universal Ownership, How Institutional Investors Can Mitigate Climatic and Existential Risks. I'm excited to introduce you to Dr. Ellen Quigley. Ellen is a Senior Research Associate in Climate Risk and Sustainable Finance at CSER, and is also the advisor to the Chief Financial Officer in Responsible Investment at the University of Cambridge. At CSER, her work centers on the mitigation of climate change and inequality through the investment policies and practices of institutional investors. She is from Saskatoon, Saskatchewan, Canada, and holds an AB in English Literature from Harvard College, an MSc in Nature, Society, and Environmental Policy from the University of Oxford, and a PhD in Economics Education from the University of Cambridge. Today, Ellen will be presenting a new universal ownership framework. Rather than addressing environmental and social risks to investors' portfolios, this new framework actively produces societal impact and mitigates existential risk in a way that is ultimately in the financial interest of universal owners. We invite you to use the swap card platform during this session. On the right side panel, feel free to share your thoughts on the live discussion board and add and upvote any questions for a speaker to answer at the end of the presentation. After the session, we invite you to use SwapCard to set up meetings with fellow conference attendees. Without further ado, welcome Dr. Ellen Quigley.
Thank you, Thomas. Well, it's a delight to be here with you today. And those of you in California, happy morning, and welcome to others in other jurisdictions. I want to talk about a number of existential risks today, but I'm also just going to flag that I'm going to be talking a bit about climate change, and I acknowledge that there is a big debate about whether it constitutes an existential risk, but I consider it to be at the very least a global catastrophic risk. So I will just be kind of lumping it in with some other risks that would be more traditionally considered X risks. So just with that disclaimer, first I just want to also outline some of the ways in which companies, especially the very large companies that are listed on the stock market, for example, are implicated in major X risks. So climate change is a pretty obvious one. About 80% of industrial emissions can be traced back to 167 companies. So that's a very large chunk of the climate change issue right there. But you can also think of, pandemics and AI, a lot of the risks associated with those two issues can be traced back to some companies that are listed on the stock market. And then there are the less obvious links between the activities of companies and a lot of the risks that we all study. And I'm going to leave aside things like supervolcanoes and asteroids and so on and so forth, because that's not particularly applicable. But if you think about the link between inequality and erosion of democracy, for example, or media companies and their influence over social discourse / social discord, you can see that companies have a lot to do with the kind of social underpinnings of the risks that stem from human behavior or interact with human behavior and thinking. So that's the reason that I want to look at the financial system in this talk, because there is a huge, there's a current contribution to these risks on the part of these companies, but also even more potential continued contribution if we don't address these risks through the tools that we have in the financial markets. So that's the basis of all of this. And I'll maybe just define some terms as I go. And if there are things that I've left unclear during the question and answer period, just tell me which things need to be defined again, because I realize it's quite an interdisciplinary crowd. So I have some sort of bad news about ESG, or responsible investment. So ESG stands for environmental, social, and governance investing. I think most of us in this space, the X-risk space, would probably assume that the focus of this kind of subfield of finance would be oriented around trying to actually address the issues that concern them. So you would assume, I think, that if you were to invest in an ethical fund or a responsible investment fund or an ESG fund, I'm just going to refer to everything as ESG for this purposes of this talk, but just know that these terms have slightly different definitions depending on who you talk to, but are generally referring to the same thing. If you invest in an ESG fund, I think you have the assumption that you're helping to address these environmental and social issues. And I suppose the bad news here is that, in fact, it's meant to be usually a risk mitigation measure for the fund manager or investor. So it's meant to protect your portfolio. It's not meant to actually reduce those risks or impacts in the real world. It is meant to reduce the impact of, say, climate change or inequality on your returns as an investor. Now, I think most people don't realize that, and it's the way the marketing tends to work in this field. You could be forgiven for having that misconception, because it's very hard to tell, even with a lot of knowledge, which products are greenwash or whatever, and which ones are actually aimed at having an impact in the real world. And I suppose what I'm hoping to do here today is to give you a few more tools to make that assessment yourself, but also to view the financial markets as a real opportunity in terms of reducing the risks that we all study. So just to dig into the different parts of the market and why we should think about them differently for a moment. So I already referred to these big companies that are listed on the stock market. So usually if you're listed on the stock market, and the moment that you list in the first place is usually called an IPO, or initial public offering. And at that moment, when, let's say you're an investor and you purchase a share in a company, the money actually does go to the company. So you are kind of meaningfully contributing to that company when you take part in an IPO. But after that stage, you are exchanging, when you purchase a share, and a share is ownership in the company. If you purchase a share in a company that's already listed on the stock market, you are basically swapping shares between and among existing shareholders, other investors. The money is not going back to the company. So it's the additionality, as in each additional dollar that you expend, is not going to actually have an impact on that company. And I've done a bunch of research on this and can tell you that the effect is basically negligible to non-existent, other than perhaps a very temporary slight share price bump, but that doesn't really affect the company. I just want to take a moment to pause and say that the divestment movement is different, because it is meant to address social discourse and basically create the conditions for better legislation for climate change. So the fossil fuel divestment movement means to stigmatize fossil fuel companies so that the public and politicians are able to kind of counteract the tremendous political power, the lobbying power of that industry, view that industry negatively, and thereby make it more likely that legislation will be passed, because humans don't tend to pass legislation unless they view a sector or activity to be morally repugnant in some way. So that's the theory of change behind divestment. So it's sort of a different argument. We can leave that to the side for the moment. Although if you don't announce that you divest, it is useless within public markets, so within public equity. So that's important to know as well. So if you're talking about public equity and you're trying to actually have an impact on the companies and thereby what they do, it's not really possible to do that by buying or selling their shares unless it's part of a big movement and you announce it and so on and so forth. Typically, you have to go about that in a very different way. So within public equity, arguably, you kind of need to use your ownership rights as effectively as possible. And I've done a bunch of research on the various mechanisms available, and that's depressing research, to be honest. Most shareholder engagement, as it's usually referred to, is quite ineffective. It tends to center around either private engagements or shareholder resolutions, which are almost always purely advisory in nature. They almost always lose. And even if they win, the implementation rate is poor because these are just advisory. And the implementation rate is extremely poor for anything that goes beyond just disclosure or reporting requests. Separately, I've gone and looked at the relationship between voluntary disclosure and actual improvements in environmental performance, for example, on the part of companies, and really haven't been able to find a correlation. In fact, sometimes it's a negative correlation, suggesting that companies are kind of basically trying to distract from their high emissions by doing very good job of disclosing. And just informally, from having done a number of qualitative interviews with investors, I can tell you that the vast majority of private engagements are also around improving disclosure. And again, just to refer back to what we were talking about before, this is because much of responsible investment, or ESG, is centered around protecting the portfolio from these risks. So that's why you would want to be asking about disclosure. You're not trying to change what a company is doing. You just want to be able to assess the risk that that company poses to your portfolio and its returns. So that's why there's this focus on things that that are much more likely to give you a better sense of how to mitigate the risk to your portfolio, as opposed to making real change. So that's within the public markets. The one thing that does seem to work is voting against the re-election of directors. So that's a vote that you have to do usually annually anyway as a shareholder, but usually there's kind of a default vote in favor of directors. If a director gets even 92% of the vote, that is viewed as kind of a rebuke on the part of the shareholders. So that's quite embarrassing for the high status individuals who tend to occupy these roles. So that does tend to kind of cause a scramble within the board. The board is able to kind of instruct the executive team what to do. That tends to produce much better results than shareholder resolutions or even private engagements. Although I have to say that the evidence on private engagements is still patchy because it's really hard to get appropriate data. But that said, the observable effects from engagements, even some of the most celebrated private engagements, usually the best you can hope for is improved transparency. Whereas if you see votes against directors at any scale, long before you actually get to the point at which you can replace a director, you do tend to see much more of a response from the company. So that's quite important if you're thinking about how to be responsible in your investments. If you want to actually decrease the risk of malicious AI or runaway climate change, you can actually use that director vote, especially in coordination with other investors, to really produce a fundamental change on the part of the company. And I would recommend making very clear what you expect them to do, etc., and having a common ask for everyone, because that's another thing that shows up in the literature, that a major weakness of current engagement efforts tends to be that people don't coalesce around the same asks. So coordination is quite important. But I also really want to talk about debt, because it's something that also does not get a lot of attention in the space. If you're wondering where the new money comes from, if we're just swapping around shares in the secondary market, as is the case when you buy a share, I think for a lot of us the question would be, well then where is new money coming from, and where is it going? So what contributes to new things being built or started, or a company's expansion plans being facilitated with capital? Then you want to know where that new money is coming from. And it really is a debt story. So here I'm going to use climate change as an example. If you look at where the money for new fossil fuel infrastructure or fossil fuel expansion comes from, about 90% comes from debt. And a majority of that is bank lending. The remainder is usually bonds or securities instruments, financial instruments. And what's interesting about that is that a lot of that comes from banks, and not that many of them. So if you can think of the name of a global bank, maybe your bank, it's almost certainly involved in financing fossil fuels directly and to a large extent. It's quite shocking if you go look at the figures, but a few dozen major global banks account for a huge percentage of that lending to fossil fuels, either directly through bank loans, as I say, or by underwriting bonds. And just explain what bonds are for a moment. The very same company you might own shares in will come to the market sometimes every few months to raise capital by issuing bonds. And when they issue a bond, they are basically getting people to lend money to them. So if you purchase a bond, you are lending money to the company that sold it to you. So through bank lending and through bonds, you see where the vast majority of new financing for fossil fuels comes from. And what I just want to dig into a couple of things here that are quite important. First, there's a bit of a misconception out there, I think, that if all you have to do is invest in the good things more, invest in green infrastructure or whatever. But what we've seen thus far is what people refer to sometimes as an addition instead of a transition. So it doesn't really matter how much more wind turbines or solar farms you build if you're also expanding fossil fuels. What we need to do is eliminate fossil fuel emissions, which account for the vast majority of greenhouse gas emissions. It doesn't help us to have built out the alternative if we haven't also wound down our fossil fuel consumption. So we really do have to focus on fossil fuels, unfortunately, when we're looking at investments. And if you do that, you have to worry, I think, particularly about fossil fuel lock-in. So the building of new infrastructure that, with the sunk cost fallacy and so on and so forth, it's very difficult to get a company or government legislation to shut down infrastructure ahead of time. It's much easier to halt the building of new fossil fuel infrastructure in the first place. And the major sources of fossil fuel consumption lock-in are, of course, coal plants, gas plants, and internal combustion engine infrastructure. So things like gas stations, and other kind of facilitating infrastructure for vehicles that run off of gas or petrol, depending on which jurisdiction you're in. So I think that if you are an investor and you're looking at how can I have the most impact on these issues, you have to kind of pay attention to the new capital, and that really is a debt story, not just with fossil fuels, but with other companies as well. So it's a major source of influence. You can decide not to purchase the bonds of certain companies, and there's evidence to suggest that even though the divestment movement hasn't historically tended to focus on the debt side of the equation, even to the extent that they have, it's already had a somewhat of an effect on the cost of capital for fossil fuel companies. So it's already a bit more expensive for fossil fuel companies to borrow money, because there are enough investors that have decided not to purchase the bonds, and banks paying attention to the kind of social and reputational risks to lending to fossil fuel companies. It's already somewhat had an effect. I should also say that there are other asset classes that also have additionality, and those include private equity, and venture capital is the big one. At the early stages, extra money is really what helps. So that's a huge source of influence, and functionally allows certain companies to grow, other companies to languish or decline, as needs to be the case with oil and gas companies, for example. So I know I've used climate change as an example rather controversially, but this does apply to other types of companies as well. So even the media companies that are highly concentrated that affect public discourse, that can affect all sorts of existential risks, everything from nuclear related risk to pandemic readiness, AI, etc. And of course there are direct impacts because of companies that are kind of involved in that early stage research and practice around AI, etc. So there are quite a number of ways in which the capital markets directly right now contribute to the major X risks that we worry about, and that actually is kind of slated to increase, unfortunately, but there are ways in which we can intervene as investors. And I'll just say, most of us probably don't have a lot of money ourselves, with some present company excluded. But for the rest of us, the biggest blocks of capital are pension funds and sovereign wealth funds. So if you have a pension, That's a big source of potential impact. They don't tend to hear from their beneficiaries at all. So the odd email is surprisingly effective. And of course, if you're in a country that has a sovereign wealth fund, that's another major block of capital. These are the institutional investors that control the markets, especially because they hire the big asset managers that we hear about as well. So that's a really huge way in which we can hopefully decrease the risk of the various risks that we study. I'll just pause there and look forward to hearing some questions from you all.
Kyle from the chat asks, how practical would it be for the EA movement at large, or high status and high net worth individuals who are aligned with the movement and interested in X risk, to gain board seats in major corporations that are contributing to the risk and impact it?
Really interesting question. I think it'd be pretty tough, to be honest, for really big companies in particular. There are whole proxy battles that happen around that. You probably read about those in the news every once in a while. But that said, I'm starting to see a really different way of approaching responsible investment in the last little while. People are starting to understand how important the board is in terms of directing the strategy of companies. So I think we're more likely to see in the future larger coalitions among very large institutional investors that actually would have the power to put somebody on a board. But I would say it would be very difficult for you to do that as an individual. You would have to get the support of some big pension funds or something like that.
Let's see. Trevor asks, is ESG worth being involved in at all, or is it truly worthless? I would be interested in what you found in your research.
My view is kind of controversial, but I actually think it is useless in its current form. Not to say that the intentions of the people involved are poor. I think that most of them think they're doing something good, which is almost worse. But I also think it can change. Like what I've just described to you, focusing on debt and doing a much more aggressive form of shareholder engagement, like that is totally possible that ESG could go in that direction if people enter the field and insist on that. So yeah, it could definitely change. It's a relatively new field, especially on this scale. So it's, yeah, there's still a chance that that things can shift, especially for, I think, institutions like pension funds that have kind of a broader social purpose in mind.
And John has a follow-up. Even if ESG investment in and of itself is worthless, if we look at it from an exclusion perspective, perhaps it's better to invest in those than to invest in non-ESG funds. I'm not exactly sure what this question's saying.
Well, I think I do get it. So they're basically saying even though ESG is useless, it's probably better than nothing. And I guess maybe from a signaling standpoint, that's true. But it is pretty useless in its current form. I'm sorry to say that. But if you had an ESG bond fund or something like that, then sure, that could be good. Although actually having looked at the contents of many ESG bond funds, I'm not totally sure they'd be that effective either. But no, I think as a signaling mechanism, that actually is kind of important because people do need to see that people have an interest in these topics. So yes, on balance, I suppose, might as well, but hopefully we can actually improve what ESG is so that it's not a choice between a useless but nicely signaling option and the status quo.
Okay. Kyle wants you to say a little more about how effective interventions work at the corporate bond level.
Right. Okay. So the real point of intervention is when a company is issuing new bonds, and that's when they're kind of shopping around to see what kind of pricing they can get and how much they'll be able to issue. And that's when it would be really important for investors to say, for example, either we're not purchasing your bonds because of these reasons, or here's what it would take in terms of behavior change on the part of the company for us to purchase those bonds. And they could even put requirements in place. I mean, that really doesn't happen yet, but that is a possibility in the future, that there be strict requirements in place for that company to follow, for them to receive more funding from investors.
Nandini asks, do you have any tips for effective AGM activism, particularly when you're representing an institution such as a university or college?
That's a great question. So if you have the power to do the voting, again, it's really important to vote against the re-election of directors. Sorry to sound like a broken record, but also maybe to signal that. I mean, respectfully, probably if you're really hostile, you might be just dismissed as a crank, and that would be unfortunate because if you do represent an institution like a university, you have legitimacy, and that actually in the literature is important as well. So if you come in with really good evidence, sound like a reasonable human, but then also indicate, we're using the harshest sanction that we have available, which is to vote against the re-election of directors. That could be a very powerful message. I would also recommend bringing in big name professors, bring out all the stuff. If you've got a university, use what universities have, which is that societal legitimacy.
One more question. I was wondering where we need to gather more data on the efficacy of activist investment strategies.
Wow, also a really good question. We need to generate those data, essentially. So one of the things I'm hoping to do is actually test out different approaches to engagement with matched sets of companies to see which things work, because there just has been not even remotely enough work done on this. Most of the work done on shareholder engagement has to do with whether it improves performance. And that's true of ESG literature as well. There's just really very little done on the actual impact that these things have, especially on environmental and social issues. So we need a lot more people studying this and generating those data themselves.